It is a beautiful Saturday morning in Chicago. It is nice and sunny. Is it the 17th of September? I am your host, the Cowboy. This is Elliott Wave Cafe. Let's get started. All right, well, before we do, please don't forget to follow me on Twitter. I'm up here at Elliott Cafe. You're going to see plenty of charts, commentaries throughout the week, throughout the day, things that I find interesting, little jokes, little things here and there, trying to get engagement, but I'm pretty sure you're going to find it interesting, so go ahead and subscribe. Also, you can find me on Telegram. This is the private pro room in here. If you want to give it a try, you can follow this link and it will take you there every single day. We talk about macro assets, we talk about Bitcoin, we talk about altcoins. I have daily videos on there every single day, plus intraday market updates. We're pretty busy in the chat room, kind of going back and forth with what's going on in the markets, but that's where you can get the meat of everything we're doing. All right, so here is what I have on today's agenda. We're going to take a look. We're going to have a quick macro overview, see what's happening across the landscape in the markets. Then we're going to take a look at the S&P 500, which hasn't been playing nice this week. So we're going to take a look at that price action. Then, is consumers really strong? We're going to take a look at the XLY and then what's happening with the volatility as well in the S&P 500, and if we can get any clues from there regarding price movements here lately. Then we're going to take a look at the recession fears and what's going on in the cycles, and what sectors are more important, what are people buying, and what's more interesting as you're possibly approaching such a scenario. We're taking a look at inflation and commodities in here. I think I got some interesting charts to show you. Then obviously oil, gold, and dollar. We'll take a look at the crypto total market cap. I got some interesting showings on the altcoin markets as well. And then we're going to close off with taking a quick look at that India 50. And then I have another two charts that I want you to see that are interesting, and they kind of relate to what we've talked about last week. So lots to talk about. We're going to start by taking a look at this quick macro overview. And what you're seeing in here, you're seeing, a bunch of charts that have been ordered in their RSI strength, on their terms of relative strength. And we're starting here with a 10-year treasury yield that it seems that it's trying to push higher and make new highs in here, but it's doing so at a slower rate. I think we're getting a little bit extended on the 10-year. Then it's followed by the dollar, which, believe it or not, even with the latest sell-off in the S&P 500 and in the NASDAQ, a little bit of a risk-off move, the dollar was not able to make a new high in here. So that's an important signal from the dollar markets that some things in here are not necessarily matching. So we're going to take a look at that. Volatility, it's been, pretty strong in here. I mean, it's been hovering at about 26, 27. They tried to break higher on Friday, and then they retraced towards the end of the day with the fake breakout. So that's another signal from the market, but that's the kind of the third one in terms of their strength. Then we take a look at copper, which continues to hold pretty well. That's an important signal for risk, since copper is not selling lower. Bitcoin is also holding pretty well near $20,000 level, even though the equities have been moving lower. So that's, again, one discrepancy here that I see between some of these markets, right? Bitcoin is holding, dollar is holding, copper is holding, VIX is not breaking higher. So things to kind of pay attention. This is all what we're calling intermarket analysis, when we look at the macro picture and we see if there is the same story happening everywhere, or if there are things that don't match. WTIC, oil continues to look weak, and then you have Russell, you have NASDAQ in here that are, some of them made new lows from the latest rally, obviously. Only we have not taken down those June lows just yet. Then the S&P 500, and then you have gold, which is the weakest in here. Then you have obviously bonds, since the interest rates are moving higher, bonds are moving lower. So TLT, it is kind of toying with the downside back in here. And then you have Dow Jones and the X. So I just wanted to kind of take a quick view of these things and just show you, how some of these things here don't necessarily match with the price action in risk. So now we're going to move on and take a look at the S&P 500, and I got quite a few things to talk about here. The first one is the count that we have here in a cycle wave 1, a cycle wave 2. You can change the labeling in here, it doesn't matter a whole lot, but big flat in a second wave here with the pandemic low in March of 2020, and then since then another pretty big impulse higher. Now a lot of analysts, and you say Elliott Wave people, and just technical analysts and whatnot, they're looking at this move here as being a terminal move, as being a fifth wave, and then it's the end of everything, and we have a massive correction ahead of us. It's possible, but as I've showed last week and a couple of weeks ago, we're still in a pretty big uptrend and pretty big secular bull market since let's say called it 2009. So here we are, continuing to kind of respect this uptrend, and it's got its corrections along the way. Now, the big questions that we have and that we face is this a wave 2 pullback? And is this wave completed or not yet? Right? And there are arguments to be made that it could be done, but I understand the bears as well, that we could be also, just midway through it, and we still have to follow with another decline lower to kind of get a bit more proportion, get to the bottom of this channel, just kind of shake off all these worries and fears, from inflation, from maybe bad earnings, from Fed tightening, for whatever reason you want to put behind a possible move lower towards 3,200. And the way it would happen is, well, there's a couple of ways that could happen, and I'll show you. But one of the ways could be that you could have a double zigzag in here. You can have a triple zigzag. You could have a W, so ABC for a W, then up in X, then another ABC for wave Y. So this is the first couple of zigzag in here. So you have the first zigzag, the second zigzag, then this move higher in here since June up into mid-August was another X wave, so just another connector move, and then you're beginning to move lower in another wave A, followed by a B, and then followed down by a C that would complete a wave Y and a wave 2, which means that this wave 2 would not be complete here, but rather would move lower towards the bottom of this trend line. Now, the moment you would get towards 3,200, you would also hit about a 61.8 or a 618 retracement on the arithmetic scale, obviously, of this entire move from these lows to these highs. So, there is a lot of reason to, to consider this a very viable alternative, but what if it's not? What if there is a lot of things underneath the market that, could convince you or could, tell you a different story, that maybe the low has already been found and this market is just kind of retesting those lows, or coming back in a correction and then is getting ready to move to the upside. Is there something to find, right in there, if that's correct or not? So again, I just wanted to present you the bearish alternate case in here and kind of how this would unfold. Now, if we take a look at the smaller time frame in here, this is kind of what you would have to see. So we're always looking for a proportion between the waves. So W, X, Y, X, and then, the Z wave. If it's getting to be this long, it would be a little bit disproportionate with W, it would be disproportionate with wave Y, right? Because, it would take a little bit longer to kind of get back all the way out here. The only way, let's say you would get some kind of a proportion maybe, if it's not going to reach these levels, but rather terminate somewhere, just a little bit quicker. So you would say that you would have, let me see if I can draw this, go back. So you would have to do something like this, where wave A would be here, and then you would get a B wave, and then you would get a C, and this would complete somewhere maybe around 3,400, 3,500 in a Z wave, right? This way you would have, more proportions between these moves in here, right? So A, B, C for a W, then this wave, and then this entire Z wave would kind of match the rest of the sell-off. Now, if you're dragging much further down, right, that's going to be quite disproportionate. So that's just kind of in my view, just a little bit of a, right look, how it would look. And the things that kind of screw things up a little bit here for the bears is this rally right here, right? Because I think they need this to be a second wave for this to be, let's say, a wave Z in form of a zigzag. If it's wave Z's can be, you know, anything they really want. They can be, it can be a zigzag, they can be a flat, right? They could be a triangle, and I don't want to spend a lot of time talking corrections, but you know, you could have, you know, you could have a 3, you could have a 3, and then you could have a 5, right? And that could be wave Z right there, all right? 3, 3 down in 5. So that's, let's say, an ABC. Then you go up here in another ABC, 80 to 90% of this entire decline, and then drop lower. And then, you know, that would be, let's say, a 3.3. You would have a zigzag here, and then you would have a flat. Okay. The other thing that you could have is you could have a big triangle in a wave Z. It's still rare, but you could have something like that. Okay. You could have, let's say, an A. So you can have a move in here, A, B, C, A, B, C, D, and E, and this would complete a wave Z, and then you move to the upside. So I know it's simple sometimes to be very, very directional in the markets, and this is one of the things that, you know, we're prone to always thinking, at least, you know, that's what I'm noticing. That's kind of what I notice in my own behavior as well, right? That you're more inclined to think volatility and moves and directional you know, price trajectory. But some other times the market doesn't give you that, and instead it moves into these kind of weird patterns and you know, triangles and choppiness and all that, and you know, they could be identified through the Elliott Wave structure as being still part of a complex correction, but they don't necessarily have to be very sharp zigzags that, let's say, maybe a lot of people just expect to get a very simple move like that, right? So I just kind of wanted to point that out and just say, you know, just keep an open mind and you know, make sure that you're understanding some of these levels that will, you know, confirm or negate some of those scenarios. So for the bulls, going back to the super directional move, this would have to be a wave 1, a wave 2, and then you get another 1. We're pulling back in a second wave, let's say early next week, and then you're beginning to crash in a 3, 4, and 5, and that would create, you know, you're going to get a third of a third, then a fourth and a fifth, and before you know it, right, you're already down somewhere up into these levels in a larger wave A. Then that's going to be followed by a B wave, maybe into the end of the year, right, with November, December, maybe get a little bit of a rally, and then sell off again into the beginning of the next year, into the spring of next year. So that means that this market will still have, you know, to continue its kind of bearish scenario. Now, let me show you this, and you know, you're very familiar by now if you've been watching my videos and my channel with, you know, and I'm not the only, and obviously I'm not the only one that's looking at this trend line. It's you know, it's visible, everybody kind of sees it, and you know, there's no argument that if you connect these two lows, you know, that's what kind of you're getting. And the other one that we were looking for was the one here in the middle, where we are right now. So it's this guy right here. Maybe I'm not going to project it too well, but you know, this is kind of where we are. So and the reason I'm showing you this is because on the next slide you will see what it would mean for this market to actually still correct, but be more in a sideways move, not necessarily super directional in a crash. Okay, and this is kind of how this will look. So you could have a WXY, which is the first leg of the correction. You know, I mean, the first correction that we've gotten, right, to the zigzag, and then instead of moving directionally lower, you can do something like, because, and I've been thinking about this for the past few days, and one of the reasons was, you know, that this move in here obviously appeared in 3 waves, but what would it be something that would surprise a lot of people in the market, right? Remember, there's a big bearish sentiment in here, and everybody thinks directional, this market, you know, it's going to crash lower, and there's a lot of reasons for that, right? I mean, how can you not be when you have a Fed that's telling you, you know, that there is more pain ahead? How can you not be when inflation is 8.5% and you're selling 5% in a day? How you cannot be when, you know, I don't know, Europe is a mess, and you know, you have elections coming here, and you know, there's a lot of stories, right? So what would be something that would surprise the markets? And I think that this type of move would be something that not a lot of people would expect, in addition with the ones that I've just showed you, that you could actually be moving sideways here in some type of a Z-wave formation and still not crash lower. And this connector in here would be another scenario like that. And you know, if you don't like this necessarily being a WXY, you could do this in an ABC, even though you got some issues with the structure. But you know, there's a very, you know, tiny way of measuring this, more impulsive than necessarily in WXY, and you can consider this an X wave. So you can have an ABCX and then another ABC coming lower. Right, and the way this X wave will unfold will be very simple. So ABC for a W, then down in X, right? Because it happens just how it does into the upside. So if a B wave pushes higher, then a B wave can push lower to the an X wave can push lower to the prior B wave low, which is right there. So if that's an ABC, you get an X near it, right? And then you rally again in another ABC towards the end of the year, into the beginning of the new year, and then you're going to crash lower. And it doesn't have to be towards 3,200. It could be back towards these levels, because you're still going to get a corrective move. You just got to overtake that by a little bit, and then you rally to the upside. And then this is a way that you can actually meet this trend line back in here, you know, with moving sideways. Remember, price, you know, corrects. I mean, corrections happen in time, right? Or they happen in price. So if you got a deep correction, right, that's a more of a price correction. If you go sideways, that's more of a time correction, because price kind of stays flat. So both of them are very viable forms of corrections, and we see them all the time in the markets. So anyway, this is one of the things that I don't know if you've seen it out there or not, but you know, I'm doing my own work, and I'm just kind of trying to think outside of the box, and not to be super complicated with the counts, but also think what could happen from another perspective. Now, the one that it's the hardest to argue, or to find, the one that's the hardest to find pro arguments for, it would be a bullish move directly from current levels to new all-time highs. And the reason for that is, even though, you know, I am leaning bullish, and that's just mostly based on sentiment, and on some of these, let's say, surprise counts that we can get into the market, along with some other fundamental data and things I'm going to show you here down the line. But it's very hard to count this as a wave 1 and a wave 2, and followed by a 3, 4, and 5. And because this move from this low to this high doesn't really look like it's a 5-wave structure. So no matter how you want to spin this, you know, I have a hard time convincing myself that that could be a 1 and this could be a 2. You know, I had a scenario where, you know, there's a 1, 2, 3, 4, and 5, and you can do, let's say, some kind of a, you know, leading diagonal, and I've talked about that, like an expanding leading diagonal, you know, 1, 2, 3, 4, and 5. You know, then you get a pullback, right, in 3 waves, and then you rally. So, but for that, you would still kind of have to get some kind of a move like that, right, which might be coming. So so this whole structure in here is not enough to convince me that you're ready to move to new all-time highs. You know, I would be very surprised if that's the case, and you know, maybe it is. Maybe there is a small fourth in here that I'm not aware of, and that's an impulsive, but it's a tough argument. So, you know, I'm you know, continuing to kind of like this, and you know, we'll see what happens. I mean, we'll definitely keep an eye on it, and I'm going to have it as an alternate in here. But you know, on Friday we closed pretty well. We went back about 3,900 on the futures, which you know, was a way of the market kind of telling you that, you know, not so far, not so fast. You know, we're still closing above 3,900, and that's an important indicator that, you know, the bears might have gotten a little bit ahead of themselves. So we'll see. All right, so on the next one here, I wanted to get you back thinking about some of the internals and some of the underlying issues in the market. So this is the S&P 500, obviously, and then this is a ratio that you're familiar with, which I've talked about, which is the ratio between the XLY and the XLP. XLY is the discretionary index. XLP, right? This one, it's more of the safe consumer staples. It's things that people buy, when they want to be safe, or things that people need and, they cannot survive without. So discretionary is things that, you can cut down on, right? You're not going to buy a car. You're not going to buy necessarily a new fridge. You're not going to buy, things that, you don't need necessarily to survive. Although the fridge, I think you don't need it, right? But, anyway, you can see the ratio here moving in favor of consumer discretionary. And what this shows you, it shows you that the consumer, or at least, market participants here are continuing to bet on the fact that, the flight to risk has already been kind of done, and it's been overblown, and they're moving from safety towards taking more risk. And this happens underneath the surface without the market telling you that, right? They're not going to come on, the CNBC and tell you, listen, there's these things happening underneath the market that, hedge funds and money managers and asset allocators and things like that start to think about. But this ratio shows you that the XLY, it's outperforming XLP, even though the market is pushing lower. I mean, look at this, right? Why wouldn't people move into safety and still bet on XLY pushing higher, when you can see the market going down? And it's like, come on, we're going to crash here. So this ratio does not believe that. It's almost like this move down in here, it doesn't have a lot of substance, and it doesn't it's not necessarily shown in this, in this ratio. So I don't know if I make myself understood here. I hope I do, but this is the consumer discretionary versus the S&P 500. This is the ratio of XLY versus SPY, and XLY is one of the, again, just one of the risk on sectors out there. It's what people buy when they're confident in things, and when they have money to spend, and when they at least think that the economy is not as bad as the media would have you think. And the ratio has been moving higher since June. Okay, look at this. You almost have like a 5-wave move higher. So it's definitely, we're not nowhere near these all-time highs in here, but it's not responding to the downside. Like, you would want to sell this, right, and buy everything else but consumer discretionary, if you believe that things are going to go down and things are bad. And this ratio shows you that, this thing is pushing to the upside. So that's another positive sign for price. And it's something that happens underneath the surface that we have to understand. Now, this is, this shows you that, again, just the relative performance versus the S&P 500 of all the 11 sectors in the S&P, right? And you're seeing in here, this is looking at the past 3 months of data, right? So ever since, the end of May, June, something like that. And, you can see in here, consumer discretionary versus the S&P, 11.9%, almost 12% outperformance. Then you're looking at utilities are still doing pretty well because they're obviously providing yield. But look at the financials, which are also doing pretty well. And this is, I don't want to get into a big discussion about the yield curve, but we've been inverted for a long time now. And I think a move into financials starts to be warranted, because if this yield curve starts to turn from being inverted to starts to steepen, financials are going to benefit a great deal. And the market starts to show you that in this performance in here. And then, energy is not doing that good. Materials, not really. Communication services, this is a bunch of stocks that have been, just kind of killed, and they're having a hard time to recover. So this sector is just, I don't even want to look at it for right now. Maybe there'll be some opportunities in there, and maybe there are. But, you look at energy, you look at financials, you look a little bit of at healthcare. It's a big mix. It's a bit of a muddy picture, because on one side you have risk, on the other side you have a little bit of safety through healthcare and utilities, but I'm surprised to see this in here. That looks pretty good. All right, next I'm going to talk a little bit about volatility, which is not a lot of people talk about, and it's something that matters in the markets, right? This shows you how much fear is out there, how the options are priced, how much people are willing to pay for protection. The volatility is higher, everything gets more expensive in terms of options, right? So if volatility is high, when you're going to buy puts for protection, you're going to have to pay a lot for that. Usually, obviously, you buy puts when volatility is low because that's when you want to have protection, right? That's when it's cheaper, right? You're supposed to buy an umbrella when it's sunny outside, not when it's raining, because when it's raining, maybe a lot of people want umbrellas and the price is going to go up. So that's the idea behind volatility in here, and it's been holding pretty steady. I mean, obviously you've had huge spikes in here during the initial phase of the sell-offs, with volatility getting towards 38, 39. We never got to 40, but this were the spikes in here where fear was so deep that you would have thought that it's the end of the world, and then volatility kind of mean reverts and comes back lower towards 20, where people sell stocks again. So now we're kind of in the middle of this range between 20 and 35, and we try to climb back up higher with the latest sell-off in the market. And we've had a little bit of a fake out on Friday, pulling back as well. But one thing I wanted to show you is the VIX, is the volatility of the VIX, which is right here at the bottom, right? This is how volatile VIX actually is. And you can see in here that we're very, very, it's a very low levels that you don't really see a whole lot, right? I mean, if you look here between, let's say, 2020 and May, June of 2022, the volatility of the VIX was above 100, with spikes into 170, 160, 150, and then reverting. And now we're in a very we're starting to be in a lower volatility regime, which means that some of these moves in the S&P 500, they do not match what the volatility market tells you, right? There is this fear here doesn't necessarily have a lot of grounds to stand on. Now, sure, this thing can spike at any time, and it can, get back up above 100. And if it does, then you kind of have to get ready that, things could start to get a little bit worse. But those times, usually, if you're an option trader, those are great times to sell volatility and, receive premium and credits and stuff like that. And that's what the option market participants are watching. But I wanted to show you that this market here, it's not really confirming what the media would have you think, that, that this market is crashing and, there's, things happening in here and you're about to go down, heavily, right? The volatility in here says, I don't think so. All right, and this could be very well kind of matching with my scenario where the market is actually moving sideways, maybe higher to an X wave, and then maybe a little bit lower, create some kind of a triangle, some kind of a chop mess that nobody really wants and nobody really expects at the moment. But that's a kind of volatility. That's the story in volatility in here, and this is what I wanted to show you. What I saw on Friday, right? I talked to my members about this. I said, watch this, because this level, if it gets taken out, probably markets are going to sell off, but also watch for a failure, because these are signals from the market. If you break a level and you don't sustain it, just like maybe you saw my video on natural gas last week, and I'll talk about it this week again. If something breaks and it doesn't sustain and it breaks back below the level that it broke from, that's a failed breakout. And I can tell you that this was an overreaction or was just a stop hunt or whatever. Now, mind you, it happened on Friday, it was at the end of the day here, but nonetheless, you got to keep an eye on this. And this is the volatility index on my futures platform. So I'm going to watch this, what happens on Sunday and Monday, and see if they're going to try to kill it back lower, get back towards 22, 23, 22, because if that happens, then the markets will likely rally. Now, I wanted to spend a little bit of time, not too much, but I wanted to show you what's going on in the business cycle and kind of how important it is to always be aware of where you are and what's the narrative out there. And if you believe that you're in an early recession or you're in a full recession, kind of what sectors are supposed to perform, outperform, not perform, whatever. And here we're looking at, let's say that you're in an early recession. And I talked this maybe about last month about this, or the end of June or something like that. I don't remember. But let's say that you're in an early recession, right, where you would have consumer expectation falling sharply, which they do, right? If you look at the Michigan consumer confidence and all that, that's kind of falling, and it's been stable, you know, for the past few reports that we've gotten, but it's still pretty low. And then you have industrial production, which is falling to stabilizing. Then you have interest rates, which, you know, they're trying again to break above, what is this, 340, 350 on the 10-year. You know, with a double top maybe there, maybe a little bit higher here, but it seems that they're trying to peak. Same for the 30. I mean, I'm looking at the bond market. We have a double bottom in there. So I don't know how much stronger, you know, the interest rate market can get, but I'm willing to, you know, to place a bet on the other side that we're probably going to pull back in yields. So we're probably peaking in interest rates, and then yield curve, it's inverted, right? And it starts to look like it might start to steepen. It might take a few more months, but so what are you? You are in an early recession. Well, what are you buying in an early recession? Well, here's what you're buying: financials, utilities, real estate, a little bit of healthcare, which is sectors that you saw just a couple of slides back as those sectors were starting to get in favor. And the financials are probably going to get even more in favor if we're moving, right, from a flat inverted to a normal yield curve or steepening yield curve. And that's when you're going to be in a full recession. Maybe we already are in one. Who knows? Who knows what this kind of fourth quarter will bring or what the data will be for third quarter. But if you're getting into a full recession, then yield curve will be normal, start to get normal. Interest rates will start to fall. Industrial production would bottom out. Consumer expectations will start to revive a little bit. And then you're getting into what? Discretionary, which is kind of what I've showed you before. A little bit of tech, communication services is still, you know, pretty beat up. Industrials. So I think we are somewhere between an early recession and a full recession maybe, and that's why you're seeing this type of price action in the market. So, you know, these things take a lot of time to turn, but, you know, I think that's kind of where we are. So to conclude, in my view, I think you're closer to the end of a bear market than to the beginning of one. And thinking about the fact that you're going to get a big crash in here, I don't think data and what I've showed you so far kind of supports that. And you can see that, you know, underneath the surface, some of these sectors are starting to get interesting. So take a look at that. I mean, look at energy. Why is energy not, I mean, it's still performing okay, but it's falling. Oil is falling. Natural gas is falling. You know, some of these, you still have a lot of good stocks in there in the energy sector that are doing pretty well, but I think they're going to stop. And, you know, that's something that you're buying towards the market top, which is exactly what the market kind of did, right? And now you're moving from that area, consumer staples and energy and materials and stuff like that, into more of the riskiest sectors. So energy, in my view, it's slowly coming out of favor. Although, you know, some people out there will have you believe that it's the, you know, the best thing since the, you know, invention of the wheel. So anyway, let's continue to take a look at what's happening with the inflation. Just a quick comparison here between the inflation rate, right? This is the year-over-year inflation rate, which kind of peaked back in June at about 9.1. The next report was lower at 8.5, and this latest report that we've gotten for August was an 8.3. Now, this is when we had the big decline because, you know, why not? Markets were, you know, expecting maybe below 8% or something like that, and you've gotten a drop, but not enough of a drop to really get the markets happy, right? All the while, actually, the inflation is coming down, if not stabilizing, but not necessarily continuing its trend. Remember, we've gone from 2%, 3% in 2020, April 2020, to almost 9%, right, in about a year. And now we're, you know, starting to calm down. And take a look at the commodities in here, what happens. You get a peak in inflation, you get a peak in commodities. You're starting to come down in here, and that looks like a bear flag or a wave 2 or a wave B, whatever it is. But I think the big chunk of this commodity movement has been made, and I just don't see how commodities can continue to rally from here. So have at it. But in my view, this is a pretty risky move to continue to press bets on here before you get some kind of a meaningful correction. So I just wanted to kind of show that and just talk a little bit about it, because if inflation continues to come down, commodities, it's a big short. And I showed that last week as well. So DBC, DBE, you can do, I think CGC, it's another one, or GCC. I don't remember the ETF exactly, but it's there's a couple of ETFs that kind of have you have a basket of commodities in there that you can trade, and I'm willing to kind of put more importance towards the short side of that trade rather than the long side. So take a look at US oil, right? Just another commodity in here. And I know we've depleted the reserves in here, the National Reserve, supposedly we're going to have to fill them back up, and that's going to be bullish for oil. And there is a floor on oil. Let's say at 80, I've heard discussions about that they're not going to let it crash below 80, and it's perfect time to get bullish oil. I don't know. I mean, how can you get bullish when you're below the 20-day moving average, when you have a crossover, with the 50, with that cross on the daily between the 50 and 200, when you're below the 20-day, when you're below some of these, let's say support now resistance levels, it's very hard for me to get bullish oil. You can hear all kind of counts on there about this being maybe a flat formation, where this is a wave A, that's a B, and that's a C. I mean, if that's a C, that's the crappiest C wave I've seen it in a long time in terms of, just a beautiful flat formation, right? It would be one of the ugliest flats I've seen. So maybe I'm not seeing it right, and maybe oil is going to go to $200, but I doubt that very much, especially with, and yeah, you can argue that China is going to open back up, and again, with the petroleum reserves and all that, but I don't know, the charts are the charts, and so far they're telling you that you almost have like a double top in here, and things are trending lower. Now, I'm going to change my mind if we're getting back above the 20-day moving average and you're starting to approach 110. Okay, fine, and you do so in a nice impulse, and then I can get behind that. But until then, I'm willing to continue to press shorts on oil, and we've done pretty well since those highs. So this is not a market that it's bullish. It doesn't look bullish at all, at least not what the price is saying. And here is, look at the count. I mean, wave A up in there. I go A, triangle, big triangle in B. 1, 2, 3, 4, 5 in a C wave, completes a W, goes up in X, A, B, C for a B wave, right? Crash, pandemic, negative oil, and then a nice impulse, 1, 2, 3, 4, and 5. This is the biggest correction we've gotten so far. I don't think it matches anything. I think it's a different one. You've broken below this trend line. So it's very hard for me to be bullish oil. I think, the likelihood of it going lower towards 60 to 65 are higher than of it going above 100. So, when you start to hear these narratives that the oil has to go up because, the petroleum reserves are getting depleted by the Biden administration, and, they're going to have to buy a bunch of oil to kind of put that back up, that's kind of a wishful thinking from the bulls. And, you hear those kind of narratives when the market, goes down, or it's the initial phases of moving down. So I'm not too happy with the oil in here, and I don't think there's going to be a big result, a big climb out of here. So that's kind of what that's my view on oil. If you don't agree with it, just let me know in the comments below, and let me know what you think. All right, gold, it's another market that, I just showed you the commodities index as well, and gold is another market that's, in my view, in a little bit of a trouble now. It's approaching, not only it's approaching, it broke this 200-week moving average. We're closing right at those lows in there, right next to it, and you could argue that, again, just like in oil, that this is a 335, and you have a big flat. Now, if it's a flat in oil and it's a flat in gold, what's going on in here? What is inflation going to go to 20%, or what's going on? Are we really expecting a rally towards 3,000 in here? If this is the biggest flat that I've ever seen, fine. 1, let's say 2, 3, 4, and 5 go towards 2,200. It's an interesting scenario. But I don't know. Again, for the market to convince me, it has to climb back above the 20-day moving average. And to do so in a nice impulse, give me a 3-wave setback, and then I can get behind it again. But until then, there might be a little bit of a bounce in here because obviously you're at the 200 week. But don't forget, you got huge resistance about towards 1800, 1700 in there. So things are going to look a little muddy for gold moving forward. Plus, you got a huge double top in here. So if anything, on the bearish side, this thing can crash towards 1500. And, the only thing that kind of holds it for right now is the 200-week moving average. Another chart that is shows you kind of what's going on with inflation and gold is the the overlay between the Treasury inflation protection securities, which is the TIPS market, right? It's what people buy when they're worried about inflation, and instead of buying bonds, right, they're buying this TIPS because they give them a little bit of a better yield. But look what the market is saying. It's coming down. It's been coming down since the beginning of the year. Late last year and beginning of this year, this market told you that this is what they think about inflation. So even though inflation continued to push to the upside, this market here was telling you a different story, and gold just follows it like a puppy. So here is the TIPS market coming down, and has the gold market coming down. So and eventually this will stop or will slow down, and you'll go sideways like this. But until then, the story to me, it's kind of clear in here between gold and inflation, and obviously inflation in general. So another thing I wanted to show you, because we're going to move to talk a little bit about the dollar in here. I think dollar is it's the elephant in the room. It's what's been screwing up things here lately for the past more than a year with its super strong rally. But I wanted to show you the difference, because we're going to start to get a reduction in the difference between the interest rates between the two continents, right? So if you're looking at the euro area ECB rates, they just started to hike. They hiked, I think in July, they've done a 50 basis points, and in September, not that long ago, right, a couple of weeks ago, I think, they've done another 75 basis points, which is one of the highest one-time increases, if not the highest in the Eurozone area history. And here we are at about, I think it's 50, because they were at 0, and they're like at 50, so it's a 125. I think it's the ECB rates right now, 125. The Fed is at about, what is now, it's about 250. With the 75 coming, they're going to be at about 325, and then they're going to get another 75. They're going to go to 4, maybe 430, maybe 450, who knows? But that's the kind of the terminal rate that the market starts to assume. I saw some looking at the CME, group Fed Watch tool, you can see that somewhere in, I think by March next year or something like that, there is some pricing of the market. It could get even above 5, right? That's a little bit of a stretch, and we'll see if that happens or not. But the direction is kind of clear that they want to continue to raise interest rates, and that's the debate. Like, how much really is the market pricing in? How much has already been priced in by this market, and where we are? And that seems to be somewhere in the neighborhood of about 450. So, but here's what happens. As this differential between the US Fed rates and the Euro rates is getting smaller, the dollar has less appeal, has less of a reason to be so strong, right? It had plenty of reasons, because the Fed was the first one that were starting to talk very hawkish about the markets, while the European zone, they weren't even thinking about it. They were continuing to ease. And the Fed was the first one to kind of start on the acceleration. And that's why you've gotten such a strong dollar. So now a lot of these countries are catching up to the dollar and to the Fed, which means that the dollar is running its course. You're also looking at the inflation. I mean, look at euro area, right? They're still climbing, right? 9.1%, their inflation rate. And it might even go a little bit higher. Who knows, right? But maybe they're going to, usually they kind of follow United States, and probably they're going to slow down, right? So if we're continuing to climb lower, they're maybe not far, from their peak, I would say. And just now the ECB starts to accelerate, and they might raise another 75 basis points on their next meeting, who knows? But I wanted to kind of show you what happens here with inflation and what happens in the euro area, and how you can benefit from that by starting to think about the dollar topping and the euro bottoming, right? And that's kind of what's shown in this few charts. And here is the inverse correlation between the dollar and the euro. Dollar is slowing down. I mean, I think that, you know, the rate of ascent, I've been talking about this for a while. I've done numerous videos on it already. You know, we had a pretty big sell-off, another climb up higher here. I think this is just a B wave, and it's probably going to correct either a B or a 2, and you're about to move to the downside. And I think there's, you know, we're not far behind a pretty decent rally in the euro market towards 104, 105. You know, might take a little while for this to further base, but first you have to stop going down before you go up, and it looks like the rate of descent in the euro, it's been slowing. I mean, it's been quite aggressive in here, and every single sell-off here, it's at a lesser and a lesser pace. Same for the dollar on its advance. So that's kind of what I'm watching, and this is what I was talking to the members as well. I mean, look at this. It almost looks like you have a 5-wave decline in here in the dollar index. Pretty good impulsive move. You broke this trend line. You're approaching the larger trend line that comes from lower levels. You're still above some of these 20 and 50-day moving averages, but you know, this does not look too impulsive. It looks like an ABC in here for a B wave, and you could get a crash in the dollar next week or over the next couple of weeks. So I'm going to watch that. I know it's counter trend, but you know, I'm going to continue to pound and just kind of stay focused on this, you know, on this market with a kind of bearish tilt in my view, right? If I'm going to get out if I'm wrong, right, and then try again until I catch, you know, the move that I'm looking for in the dollar, in the euro, and in some of these, let's say, risk assets in here, right? You don't have to be right from the first time. You just have to know that, you know, you're approaching that, right? That you're moving into the right direction, and your thesis, you know, it's right. It just takes time for that market to top out. So that's what's going on in the dollar, and you know, we'll continue to monitor it in here with the members. And you know, I talk about this thing every single day. I do videos on it, I do charts in the chat room, and we're kind of going back and forth because, you know, it's a big indicator, and we're watching it every single day. It's one of the main you know, gauges on the dashboard, along with yields, along with gold, along with oil, along with, you know, bonds, and the rest of the market. That's giving us clues about, you know, what's happening overall. And listen, in the pro room, you know, I'm doing daily videos every single day. This is pro member daily video update. So I'm doing this, you know, usually in the afternoon, like 4 or 5 o'clock after the markets close. And, you know, there's a 10 to 15, sometimes even a 20-minute video where I go about the price action on the day, what I'm seeing, what I like, what I don't like, where the trades are, you know, what's important, what to watch for the next day. I'm doing a different video soon after for Bitcoin. So I have a separate Bitcoin channel that's part of the program as well, but that's just videos on Bitcoin and talk about, you know, the crypto market a little bit, and kind of how it reacts, how it matches what's happening in the macro landscape, right, and what the levels are, and that's that. So plus intraday market commentaries. Now also, don't forget, if you subscribe to my channel on Telegram for a year, which is not expensive at all, you're going to get a 7-hour course in there. And I don't know if, you know, you guys know about this or not. I'm not, you know, really promoting that too much, but there's a 7-hour Elliott Wave course that comes with a yearly subscription, which on its own, it's worth, you know, just the full yearly subscription. So if you want to learn, if you don't know Elliott Wave, or if you're, you know, looking for information on that, I have a 7-hour video course, and each of these lessons in here, I don't have them all on here, but each of these lessons has its own PDF file that you can print and look and study and just understand the relationship between the fibs, corrective waves, how to trade some of this stuff, examples, and what's, you know, what to look for when your wave count is wrong, and you know, I mean, it's everything. I've done this in 2019, so right before the pandemic, and you know, it's got a lot of views, and it's still going strong. So you guys go ahead and check that out if you want. Anyway, just a little plug on the program if you're interested in coming up there and spending time with us. All right, the next one, it's the crypto. My goodness, 48 minutes I'm into this video. Jeez. All right, so let's wrap this up. But anyway, crypto total market cap, it's holding. It's holding. We haven't broken below 790 billion, 780 billion. We haven't broken. We haven't made a new low, even though the markets, you know, look pretty weak, let's say, right? Or they were acting weak in the S&P 500. But you're still in this kind of higher low level. Is this a 1 and a 2? I mean, it's ambitious. Maybe we're still in some kind of a, you know, like I said, into the S&P 500, maybe this is going to be an ABC and some kind of an X wave, followed by a pretty decent rally, right? Not everything has to be 1 and 2s, right? They could be X's and they could be B's and, you know, Z wave, stuff like that, that you're kind of moving more sideways. So, the one thing that I would not like to see, though, it's making a new low in here, because that's going to open a big can of worms for a big impulse of the highs, and that would be a wave 1, 2, 3, 4, and 5. And if that happens, if you get a 5-wave move, we know we're going to be getting a pretty decent rally. So no matter what, it's coming. But the problem is what's coming after that. You're going to get an ABC, and then you're going to get a big market crash later on next year or whatever. But you really don't want to have a 5-wave move of these highs, because however you want to stretch a flat, I mean, some of you will stretch a flat here saying that that's a 3, 3, and then 1, 2, 3, 4, 5, and that's a big flat. It's not. You know, flats got to have a little bit of a proportion and a right look, and this is already getting so big that it got nothing to do with this high in the market terminating here and this being an A, that's a B, and that's a C. It's in my book, that's a bit of a stretch, and I've been around a little while with the Elliott Wave, so I could be wrong, obviously, but that's just kind of I'm just telling you straight. I don't think that's a flat. It's going to be, if it's going to be a 1, 2, 3, 4, 5, that's going to be a wave A. And then you're probably going to get a B, and then you're going to get a C wave, massive decline, and then a much bigger crash later on. Who knows? Maybe because of, you know, regulations. Maybe Gary Gensler comes out and says, listen, these are all securities, delete them, get them off the exchanges. I have no idea. But so far we've been surviving. Another important point is that this here was a capitulation low. Don't forget about that. Don't forget the bad news that we've had when this market sold off like crazy. Don't forget what happened to Luna. Don't forget what happened to, you know, whatever, Three Arrows Capital. Don't forget what happened to Celsius. Don't forget Voyager. You know, just miners capitulating, a lot of stuff. So this was in here, was the peak in sentiment for bearishness. Right now, even though your fear and greed index is still, I don't know, 18 to 20 in there, I don't know if it's really justified or it's not, doesn't feel that bad anymore, right? So even if you're going to break lower, people are going to be, you know, we're kind of expecting that. I talked about this, but, you know, so the fact that you've capitulated in here, you know, usually marks the low in the market. You can still drag and maybe make one more low, but again, the conviction in that low, it's so reduced that you know that the next move is going to be an explosion higher. So we're not far from this altcoin market and Bitcoin market and crypto market staging some impressive rallies down the line in here. So you know, we'll see, but again, don't be super upset or desperate that if you're breaking to a new low in here, it's the end of everything. Not for a while, at least, right? Even if you're going to break, what I don't like is the 5-wave structure. I know a rally it's coming, either from here or from slightly lower. It just changes a little bit the picture longer term. That's all it is. So we'll see. We'll see what happens. But I wanted to show you some relative rotation in terms of altcoins. I don't talk a lot about this. I do weekly presentations on altcoins in the Pro Room, where I go every single week. I go over all of them, about 40. I think we're watching and looking at their price structures, where they are in relationship with their moving averages, how the wave counts are looking, and try to talk to my members about it. But one of these things I wanted to show you is the fact that this is a weekly time frame. And as you know, this is a relative rotation, which means that in the center here, I have the dollar, and then they're rotating in and out of favor. And they have been improving. They have spent a long time here in the lagging quadrant, right, in the big sell-offs. And look at them. They're all up in the blue. And actually, Ethereum Classic, it's up in the green, which means it's one of the strongest. So, you know, we got TRX, which is not doing much. You got Zilliqa trying to get back from lagging up in here. You got Waves, you got FTM. Atom is one that's very, very strong. Because the further they are from the center, the higher the volatility, the stronger they are. So, you know, when you're looking in here, that's the momentum scale, this Y scale, and the X scale is the ratio, so it's the relative strength next to the dollar, how stronger they are. And then when they're tilting lower, they're losing some of their relative strength. Okay, that's kind of what that means. So I hope we're not getting a hook, which means that you're turning and you're getting back into lagging. I don't think so. because they're, you know, they're acting pretty well, and I want to show you what's happening on the daily time frames. But look at the daily. Look at the Atom. You know, very strong here on the leading quadrant, and it's pointing to the upside still. EOS, you know, has never gotten into the lagging. It lost a little bit of momentum, but it's still outperforming the dollar pretty well in terms of, you know, and it's coming back here. So, you know, we got a bunch of them, HNT pointing higher, and a lot of them here on the daily, they're kind of matching what's happening on the weeklies. So I would not be too bearish alts, you know, I don't know. I mean, you see a lot of bases in there, ADA, you know, Algo, a lot of them have flat formations at the bottom. They've been sitting there for a long time. And they're sitting there for a reason, because, you know, even if you're going to break, you're going to do a quick break and then reverse. So maybe we're in an accumulation process, a big accumulation process, and I would use these levels to try to accumulate. And listen, these videos are obviously for educational purposes and no financial advice, and you know the story. But, you know, I don't know, it looks kind of not a bad level, you know, to get involved. Again, it's a risk market, you know, so if regulators come after us or after the crypto market, you know, it is what it is. But that's why they say don't invest the money you cannot afford to lose, I guess. I'm going to move on to the 3 charts that you got to see, and I'm going to be quickly through these so I can finish up this video, which is about almost an hour. My God. Okay, natural gas. Talked about this last week. We were looking for a rally, for a B wave rally in here, right? Or a wave 2. Look at that. Okay, the markets are not that complicated. If you're going to get some kind of a head and shoulder formation, and not always is that perfect, but I mean, this is pretty perfect. You know, move lower into the neckline, you rally back up higher. That's what we were watching for. And I talked to my members about, listen, time to short natural gas in here. I put it on Twitter too. You know, and what is natural gas now? Back to these lows. We'll see if it's going to break below. Probably will. Probably will. It's probably going to take its time, maybe break a little bit, then retest it, then, you know, but I still think, based on this formation, natural gas might come towards $6. We'll see. Again, same with the oil story, right? I mean, this is energy. This is what energy shows you. So it's hard to be an energy bull based on this formation. India 50. This is what I've talked about in September 9th, right? Or September 10. And we were looking for a new high in there. And here it is. Back a new high above 18,000 in India. I still think that this market is one of the strongest out there. It's got an ABCWX, ABCY, pretty big rally next to the X wave. Is this another X? It's hard to believe that, because this is a very impulsive move. So you could make maybe more of a 3-wave move in this X wave. This one, it's a little more clean. But, you know, if we can break above 18,187, I think India can really start to push to the upside in here. Now, I do have a little bit of an issue with this structure, because it does look like, this does not look like a final fifth. So either this 4th wave is still forming as a flat in a 3-3-5. You can see 3-wave decline, 3-wave rally. Either there's some kind of a triangle here with another push higher. So just kind of be cautious, because you're obviously at resistance levels. I would not press my luck now that this high has been made. I would just kind of be patient and wait for a good break of this 18,200 to really get bullish on India more. For right now, you know, we're still in a little bit of a correction and just kind of sideways move. And I talked about this in the program as well. So, you know, anyway, important chart. I just kind of wanted to show you how that's kind of been cleaned up. And the other one I wanted to show you is the dollar yen. I think this is the bigger trade on the deck right now. I think long yen, it's, I mean, people have been trying to catch it, but I didn't get in it. I'm like, you know, no, this is not done selling. You know, there's no point yet. There's just kind of, I tried a couple of times with you know, small gains, small losses, but nothing. But now I'm starting to kind of get more serious about it. And I think the yen is probably prone to some massive rallies coming out. We're hearing talk from the Bank of Japan that they might intervene in the markets. Could be a lot of jawboning, but the charts seem to start to agree. So we're losing the RSI with every high that we're making. You know, I mean, look at this thing, right? And look at the structure. I mean, 1, 2, 1, 2, 3, 4, 5. I mean, even if you're going to climb a little bit higher, it's not the end of the world. This thing, it's not far from coming lower significantly, right? I mean, you're talking from 130, you're talking about 1,000 pips drop. So pay attention to dollar yen. I don't know if you guys trade this or not, but it's you know, I go where the money is. I go where the trades are. I go where things are interesting, something that's out of the ordinary, something that catches my eye, you know. And I love to look at the markets from that macro perspective. It's like, hey, what the rates are doing, let's go there. What's the oil doing, let's go there. What's natural gas doing, let's go there. You know, I really don't care what I trade. If the charts are showing me interesting patterns, I'll be all over it. So looking at this is a zoom in of this kind of latest leg up. 1, 2, maybe a couple of legs still, or maybe not. I'm ready, because this thing, it's you know, looks fairly interesting. So I'm looking for a drop back towards 130, 135, and let's see if we can get that. I'm going to leave those limits out there just in case I wake up one morning and Bank of Japan, you know, it's intervening and this thing is shooting up through the moon. Probably not going to last, but, you know, things happen. I've seen that in 2008, 2009. So, you know, definitely an interesting market. I'm going to continue to try to build a pretty good short position in the dollar yen, long yen. That's what that means. And as always, guys, I really appreciate you. We just hit 1 hour. Hopefully you had enough time to kind of get through this and listen to my ramblings. I appreciate you. We're getting close to 5,000 subscribers on YouTube. So don't forget to subscribe and like, and visit me in the pro room. You know, come and say hi. Visit me on Twitter. Leave your comments below. I want to hear what you have to say. And, you know, I respond. If you go back in my videos, you'll see, you know, let's say 8 out of 10 comments I'm usually responding to. So again, thanks for watching. I appreciate you all. Talk to you next time. Bye-bye.